Hi, my name is Rory King, and I'm a second year finance student at Georgia Tech from Decatur, Georgia. My stocks are JB Hunt, Qualcomm, SAP, and SLB. Outside of this research, I'm involved in various clubs and activities. Let's talk about the company. Schlumberger Limited, or SLB, was founded in 1926 by brothers Conrad and Marcel Schlumberger. It has grown into a publicly traded Fortune 500 company and is the largest oil field services provider in the world, operating in over 100 countries and headquartered in Houston, Texas. The company focuses on driving energy innovation for a balanced planet. SLB provides a wide range of services, including reservoir characterization, drilling, production, and digital solutions for the oil and gas industry. It emphasizes technological leadership and data-driven insights to optimize energy extraction and efficiency. In recent years, SLB has also expanded its focus towards sustainability, investing in low-carbon technologies such as carbon capture, hydrogen, and geothermal energy. SLB's core segments include digital, reservoir performance, well construction, and production systems, with growing emphasis on higher-margin, technology-driven offerings. Now, let's talk about earnings from Q1 2026. First quarter 2026 revenue was approximately $8.7 billion, up 3% year over year. However, excluding the impact of the ChampionX acquisition, revenue declined by 7% year over year, primarily attributed to disruptions in the Middle East. Sequentially, revenue declined by approximately 10.5% compared to Q4 2025, reflecting operational shutdowns and greater impacts from the geopolitical conflict currently going on. SLB had EPS of 50 cents per share, which is down 14% year over year, and adjusted EPS of 52 cents per share, which is down 28% year over year. Net income was $752 million, down 6% year over year, and SLB's EBITDA was $1.77 billion, down 12% year over year. Margins were negatively impacted by lost Middle East revenue, increased logistical and procurement costs, particularly in offshore and OneSubsea operations. Now, let's talk about the earnings call a little bit. Management emphasized that geopolitical disruptions in the Middle East were the primary driver of near-term weakness, particularly in countries such as Qatar and Iraq, where operational shutdowns and security concerns impacted offshore and production activity. Despite these issues, the company expects a gradual recovery in the region, with activity resuming at different paces, depending on the severity of disruptions and the natures of the activities themselves. Looking forward, management expects a constructive macro environment driven by energy security concerns, supply-demand rebalancing, replenishment of global inventories, and obviously, or hopefully, the reduction in the impact from geopolitical conflict. Oil prices, however, are expected to remain above pre-conflict levels, supporting increased upstream investment projects, which we'll see later when we look into the CapEx for the quarter. Management also highlights the strong growth of data center solutions, with 45% year-over-year growth and the expectation of this trend continuing, and digital and data center solutions taking up a larger and larger portion of the overall production of the firm. Let's talk about the model now. On one note, I was unable to add a investor presentation, but here is the webcast if you want to look in. You can just put your information in and then give it a listen and come to your own conclusions. Okay, let's talk about the model. Capital expenditures for the quarter were $510 million, which reflects a CapEx as a share of revenue of around 6% compared to a historical share of around 5%. SLB has long-term debt of about $9.67 billion, short-term debt of around $1.94 billion, and cash of around $3.39 billion. The lower cash position reflects the greater investment made from the increase in capital expenditures in the quarter. I expect, for my assumptions, that revenue growth will recover gradually over the next several quarters and into the next few years as Middle East activity resumes and international markets offset the recent and near-term disruptions. over the medium term, these greater capex and greater investments that SLB has made will likely lead to an increase in revenue, especially investments into the digital infrastructure. However, these drivers are partially offset by the cyclical nature of the oil and the energy industry and the potential for extended geopolitical risk. I also expect margins to recover as hopefully the current geopolitical environment becomes less strained, though it's worth noting that this is not a guarantee and the conflict could last a lot longer than you, me, or anyone else hopes. With a target PE of around 18, this gives us an intrinsic value of $53.71 per share, which is a downside of around 1% compared to the current share price of $56.15 per share. Thus, I would recommend a hold for SLB. Thank you.